So we're looking forward to the Fed today. We're going to see, what's going to go on with what Jerome Powell is saying and whether they're going to keep rates on hold, cut, or hike. And then we're going to have a run through of some charts because I think we do neglect the charts a little bit from a technical perspective. I know a lot of you guys like your charts. And then today's trading takeout is going to be why we have to pay attention to volatility when it is trading down. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So firstly, what is going to happen at today's Fed meeting? Well, I should hope that this table is pretty evident. It's showing that we're going to hold, 99.7% chance that the market is pricing that we hold. The key thing here, though, is what if something different does happen? Because, as I mentioned all the time, the one constant in markets when you are looking for a big move, or you don't have to be looking for a big move, but what creates big moves basically is surprise. So if there is any deviation whatsoever from 525 to 550 basis point range, so if there's a cut or a hike, that will cause pandemonium. It will cause pandemonium to the downside in this case, though. It will not be pandemonium to the upside because you've got a leaning on economic data being worsening, not worse currently. The market's pricing in worsening data. And so either way in which it goes, if it were to be a hike, it would simply make stocks more expensive relative to the risk-free rate of return. If it were to be a cut, it would confirm the market's view that economic data is worsening, that the Fed sees something bad happening out there, and all hell will break loose. Combining with this, there's the VIX that we're going to talk about, or volatility that we're going to talk about for the trade and takeout. But combining with this is the fact that the VIX is at 18 still. So 18 compared to recent times is still quite high. We had the sell-off over the last couple of weeks. Market traded 41.50-ish roughly on the ES, I believe. So with a high VIX as well, you're still looking at higher relative and realized volatility, which doesn't promote the idea that stocks could really get a real big rally. There's calculations on how the VIX works. It's a 30-day variance swap on different strikes on the S&P 500 options. It doesn't just mean that things are more volatile. It's just a calculation on things to do with options, basically. But if the market starts expecting that volatility is likely to spike, it's up a tiny bit so far today, then the direction would, in my view, be to the downside. And with regards to this economic data, we've got to look at the economic data that could potentially be worsening elsewhere, which would drive the Fed's views. So in Europe, for example, economic data is really, really poor. Germany, actually in really strong disinflation now. We have 3.8% print. Just 2 days ago on Monday, I believe, 3.8% expected was 4%. So the ECB rate hikes are working through there, but maybe not in the way as intended. Rather than it being contractionary, it's actually just Germany being really, really economically in the doldrums. So problems there in Europe. The Fed are definitely going to be watching Europe for that. But from my point of view, there is nothing right now that would suggest stocks to get a rally off of any kind of interest rate change. In fact, it would be to the downside. The market is poised for lower prices, in my view. Now, on to some charts. And I've spoken about the Fed probably being negative for stocks. And I do think that's the correct view to take. But to provide you with another perspective, I guess, is if we take a look at ES, so the S&P E-mini futures, and you'll see here how it's traded just recently. Now, this isn't confirming or denying my initial view, but you might want to have a look just at this pin bar here, how we've traded under the low and the market got bid back right away. For most, this would look bullish, and I think many people would say, okay, yeah, well, that's bullish. Look, it's even gapped up again over the weekend. For me, though, it's not. It's not at all. And this is kind of where I want people to be a little bit cautious, because it would be bullish if this close were above this low. So if the close here, which you might see, let me actually change this to candles because people are probably more familiar. If this candle were to have closed above the red line, then I would have said, okay, that's bullish. But because we closed below there, it's kind of an acceptance of the lower prices. Buyers basically couldn't overcome the low that we formed back in May. It's kind of a double bottom there as well. So generally what you'd want to see is the market come back, and this is probably a better example of it, right? So you can see here, obviously flip this around, but the market traded above here and then closed below. That is exactly what you'd want to see at the low. It's different in a bullish market. Did this work here? No. Yeah, well, this kind of worked it as well. So there's a double bottomish pattern here, outside day. And then you can see that we closed well above it all the way up here. So we traded below it, closed above it. And yeah. So what is this signifying? That there's no strength. There's no buying strength below here. There was no desire to push the market higher and close, anywhere up here. So what do we possibly have there? If there was no buying strength, well, what does that mean? I guess it means that there's some weak buyers there. And if you're considering who has intent in the market, you could argue that these buyers are likely going to have their stops maybe below this low, because they might have been targeting the 200 daily moving average up here, or they might have been targeting, this prior high or something like that. So they're likely to have a relatively wide stop, which gives some credence to the move that we could push through and start seeing 40, 50, for example, which is about 100 points off of the level we're at now. Alternatively, there is the 200 daily moving average, which CTAs do love to position around. So if for some crazy reason we do get a bullish move, 4,300 could be in play, or just above 42.92 in my view. Again, I've laid out that I think the probability lies of the market ticking to the downside. It's where the flow is. It's where people are positioned for currently. And this weakness in this buying here just feels very, very off to me. So I'd argue that we could cap on any kind of volatility about here. So 42.54-ish, that could be a top, and we could see a move like this, or we just start trading down today. That's what I see. So those are the two scenarios that I see. I don't think we'll touch up there for a little while, the 200 daily. We tend not to even to come back and retest it. If you look through, here's probably a good example of where we do it, but that's quite a broad rally with some fundamentals backing it. I don't see the fundamentals in play there. So yeah, that's where I'm looking at on the ES. Now, if we go back to the euro, we have seen some more selling. So we've seen selling today again. Market opened just at 105.73, 75-ish, something like that. So we're about 20 ticks lower already. This is just showing dollar strength at the end of the day. Euro is dollar strength. And if we look at how we've traded since July, it has just been one-way traffic. It's been a grind. Now, in terms of technicals, the market is 60% long now in terms of retail traders long. I would argue that there are probably some people who are still buying here, who are still getting absolutely shafted. And if you look at how this is sort of positioned from a pattern perspective, it's a head and shoulders-y type pattern, right? I don't care about the patterns. What I care about is how heavy the book is. And if I see that on large brokers, you've got 60 to 70% positioned long, and the pattern looks like it is going to play out, then that's a fantastic signal. That's when really technical patterns do play out, is when the book is of uninformed traders is one way, and the pattern is, in the traditional sense, the textbook sense. So that tends to be when they work best, and vice versa as well. Patterns fail when, you know, people are playing for the pattern, but the book's not suggesting that it should work out. You know, at the end of the day, the brokerage business is based on internalizing uninformed flow. And then if you look at the stats, you know, you've got 70, 80% of people are losing. Well, you have to then marry the two up. Why are most trading patterns when the patterns are failing? When brokers are making money on 80% of their traders? It kind of works like that. So you've got to think of these things in a more conceptual way. Okay, who is the counterparty? What might they be doing wrong? Who is stuck in the market? You know, who is stuck? You've got a lot of people, especially in the retail sphere, that are anti-dollar for some reason. They're conspiratorial, think they're smarter than the market, think they're smarter than global economies, and it baffles me. So you do get people emotionally fighting dollar strength, which is a fantastic cue just to, you know, sell into that emotion on the euro, that is. So, yeah, those are the two real charts to focus on today, the euro and the ES or S&P SPX, whatever it's called, with your CFD provider or whatever it's called on Axie. And yes, I think that's everything that I really wanted to cover. Everything else is a derivative of those two. So any kind of commodity-backed currency versus the dollar is going to be a derivative of risk. The ones to look at potentially as a complete outsider to those is probably Swiss yen. Swiss yen's a very, very interesting pair. We can have a look at that quickly, actually. I'm not necessarily recommending to trade it at all, but because of the fundamentals of it, if you're looking for a play on strange monetary policy, which, you know, the SNB and BOJ are having, it's definitely one to look at. And if you look at it from a longer term perspective as well, you can see that we broke basically the all-time high from 1979 just a couple of weeks ago, which is pretty insane. And it's now trading 166.36, which is even more insane. And it doesn't look like it's stopping, which is even scarier. The yen weakness right now is just insane. So it's a really tricky one to get on board with, because I do think there's a turning point, but I don't think it's yet. I'm not in this. I was in it for a little bit when we had the first intervention last year, which was actually, I believe, down here. This was the first. No, where was that first intervention? I can't even recall now. But it was last year at some point, and it was very, very strange trade. It went up 200 ticks in about 2-3 hours. So yeah, odd one. But yeah, Swiss yen is a one really, really interesting currency pair to have a peek at. So this is just a brief primer on the VIX. And why, when it is trending down, especially in a higher interest rate environment, you've probably got to be careful. And it's definitely connected to the reasons that I've spoken about today already. It's definitely connected to the fact that there could be surprise on the FOMC. I don't think there will be, but there could be. And in this environment, when data is very, very mixed, when data is trending down relative to where it's been before, surprise is apparent. You know, the VIX isn't a surprise indicator necessarily. It's always quoted as that, but as I mentioned in the previous video, it is an expression of a 30-day variance swap. Now that is absolute, you know, Greek to me. Ironically, that's what they call Greek components of options. Anyway, I'm getting off path. But what you've got to realize is that when volatility is trending down in this environment, anything can uptick it. There's a lot of things that can occur. You know, balance sheets are being sold off on global central banks. So the same liquidity isn't there. We're in a very different liquidity profile now compared to the last, say, 10 years. Very, very different. We've had rate hikes that have gone rapid. So I think when volatility is trending down in a higher rate environment, it's always pays to be aware of how that can change very, very quickly.